So you just got a $3,000 bonus at work. Congratulations. And now you're sitting there staring at your bank account thinking about what to do with it. Should you throw it in your Roth IRA, max out your 401k, pay down your credit card, start that taxable brokerage account everyone's been talking about, buy some crypto because your cousin's been messaging you about it? Look, here's the thing. You end up doing what feels good instead of what actually makes sense. You throw $1,000 at your student loans, put $500 in a Roth, buy $1,000 worth of whatever stock is trending, and keep $500 in checking just in case. And now you've got money scattered across 5 different places with zero strategy behind any of it. I see this constantly. People treat their finances like they're throwing darts at a board, hoping something sticks. And the worst part? The order you do this in matters way more than most people realize. My name is Rayhan, and I spend way too much time thinking about optimal investment strategies and why 90% of people are doing this completely backwards. If you're someone who's making decent money but still feels like you're not making any real progress financially, like you're investing but not actually building wealth, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, I'm going to give you the exact order you should be putting your money to work. Not some vague advice like invest in yourself or save for retirement. I'm talking about step 1, step 2, step 3, a literal checklist that you can follow tomorrow. The order in which you invest is literally worth hundreds of thousands of dollars over your lifetime. I'm not exaggerating. The difference between someone who follows the right sequence and someone who doesn't can be a $400,000 to $600,000 gap by retirement. Let me show you what I mean with a real example. Meet Sarah. She's 28, makes $75,000 a year, and she's trying to do everything right. She's putting $500 a month into her 401k. Good, right? She's also putting $300 a month into a Roth IRA. She's even started a taxable brokerage account where she puts $200 a month. Look at her go. She's investing $1,000 a month. She should be proud of herself. Except here's the problem. Sarah has $8,000 in credit card debt at 22% interest, and she only has $1,500 in her savings account. Now, you might be thinking, okay, but at least she's investing, right? That's better than nothing. And here's where I'm going to frustrate you a little bit. No, it's not even close. That credit card debt, it's costing her $1,760 per year in interest. That's $146 per month going straight to the bank for absolutely nothing. Meanwhile, her investments, even if we're optimistic and say they're earning 10% annually, are only making her about $600 in the first year on that $12,000 she's putting away. So she's paying $1,760 to borrow money while simultaneously earning maybe $600 of the money she's investing. She's losing $1,160 per year on this arrangement, and it gets worse every single year because that credit card debt compounds against her while her investment balance is still small. This is where it gets really interesting because most personal finance advice will tell you pay off high interest debt and invest early, but they don't tell you the order or the why behind it. Here's the thing about money. It's not just about having it's about having it working for you in the right places at the right time. According to a 2023 study by Northwestern Mutual, 78% of Americans say they feel financially insecure, despite 64% of them having some form of retirement account. That's not a coincidence. They're investing, but they're doing it randomly. They're leaving money on the table every single month because nobody ever gave them the roadmap. Let me give you another example that's going to make this crystal clear. 2 people, Jake and Maria, both 30 years old, both making $80,000 per year. Both decide to invest $500 per month for the next 30 years. Same amount, same timeline. Jake follows the wrong order. He puts everything into his 401k, but he doesn't prioritize the company match properly, he pays taxes unnecessarily, and he keeps high-interest debt around because everyone has debt. Maria follows the exact order I'm about to give you. At age 60, Jake has about $1.1 million. Not bad, right? Sounds like a success story. Maria, she has $1.8 million. Same exact starting point, same amount invested per month, but a $700,000 difference because she did things in the right order. Now, you might be thinking, okay, Rayhan, that's a huge claim. How is the order that important? Look, it comes down to three things: free money, tax optimization, and avoiding financial friction. And most people get all three of these completely wrong because they've never actually seen the full picture laid out. All right, I want you to think of this like a video game. You can't skip levels, you can't jump ahead. Each step unlocks the next one, and if you try to skip steps, you're literally leaving money on the table. Step 1. Build a starter emergency fund, $1,000 to $2,000. Before you invest a single dollar, you need $1,000 to $2,000 in a savings account. That's it. Not $10,000, not 6 months of expenses yet, just enough to cover a basic emergency. Here's why this comes first. Life is expensive and unpredictable. Your car breaks down, your dog needs emergency surgery, your laptop dies the week before a major presentation. If you don't have this money set aside, you know what happens? You go into debt, and debt is the enemy of wealth building. I don't care how good your 401k match is. I don't care what Bitcoin is doing. If you don't have this money, you need to get it before you do anything else. Because here's what most people don't realize. If you invest $1,000 but then have to put $1,200 on a credit card at 22% interest 3 months later, you just lost money. You went backwards. This starter emergency fund is your financial friction reducer. It keeps you from sabotaging yourself. Step 2. Capture your full employer 401k match. Once you have that starter fund, immediately, and I mean immediately, contribute enough to your 401k to get the full company match. This is literally the only guaranteed 100% return on investment you will ever get in your entire life. If your company matches 50% of your contributions up to 6% of your salary, and you're not doing this, you're turning down free money. It's that simple. Let's make this concrete. If you make $60,000 per year and your company matches 50% up to 6%, that's $1,800 of completely free money every single year. Over 30 years at a 7% return, that turns into $177,000, and you didn't have to do anything except take the money they were offering you. I cannot stress this enough. People who don't capture their full match are making one of the single biggest financial mistakes possible. You are working for a company that is offering you a raise, and you're saying no thanks. So stop doing that with your retirement match. Now, here's the psychological shift you need to make. Your match is not a bonus. It's not extra. It's part of your compensation package. Would you tell your boss, hey, I only want 90% of my salary, you can keep the other 10%? No, so stop doing that with your retirement match. Step 3. Pay off high-interest debt, anything above 7%. All right, you've got your emergency fund, you're capturing your match, now it's time to kill your high-interest debt with extreme prejudice. Any debt above 7% interest needs to go. Credit cards, personal loans, car loans with terrible rates, all of it. Why 7%? Because that's approximately what you can expect from stock market returns long term. Anything above that, and you're mathematically better off paying down the debt than investing. This is where people get emotional and start arguing with me. But Rayhan, Dave Ramsey says pay off all debt. Or, but Rayhan, the stock market can do better than 7%. Look, here's the thing about high-interest debt. It's a guaranteed negative return. If you have credit card debt at 22%, you are guaranteeing yourself a negative 22% return on that money. The stock market might give you 10% this year, or it might give you negative 15%. That credit card, though, it's giving you negative 22% no matter what. Let me give you the math that changed my perspective on this forever. Let's say you have $10,000 in credit card debt at 22% interest, and you also have $10,000 you could invest. If you invest that $10,000 and it earns 10% per year while you make minimum payments on the credit card, here's what happens over 5 years. Your investment grows to $16,105. Nice. Your credit card debt, even with minimum payments, costs you about $7,800 in interest over those 5 years. Net result, you're up about $8,300. But if you had paid off the credit card first and then invested, you'd save that $7,800 in interest, and your investments over the remaining time would grow to about $11,400. It's not even close. The debt payoff wins every time because you're eliminating a guaranteed loss. Step 4. Build your full emergency fund, 3 to 6 months of expenses. Now that you're not bleeding money to high-interest debt, it's time to build up your full emergency fund. This is 3 to 6 months of expenses sitting in a high-yield savings account. I know. This feels boring. This feels like you're not making progress. You want to be investing, building wealth, watching your money grow. But here's what most people don't realize. An emergency fund isn't just about emergencies, it's about confidence. When you have 6 months of expenses saved, you make different decisions. You negotiate harder at work because you're not desperate. You don't stay in a toxic job because you need the paycheck. You don't panic sell your investments when the market drops because you know you're covered. According to the Federal Reserve's 2023 report on the economic well-being of U.S. households, 37% of Americans couldn't cover a $400 emergency without borrowing money or selling something. Think about that. $400. That's not a month of expenses. That's not a job loss. That's a car repair. These people are one flat tire away from going into debt. And when you're one emergency away from debt, you can't take the risks that build real wealth. Your emergency fund is what separates you from the 37% who are stuck in survival mode. Step 5. Max out your HSA if you have one. This is the step most people skip, and it drives me crazy because an HSA is literally the most tax advantageous account that exists. If you have a high deductible health plan, you can contribute to an HSA. For 2024, that's $4,150 for individuals or $8,330 for families. And here's what makes it special. It's triple tax advantageous. You contribute pre-tax dollars, tax-free going in, it grows tax-free, no capital gains taxes, and you withdraw it tax-free for medical expenses. No other account does this, not your 401k, not your Roth IRA, nothing. And here's the secret that wealthy people know. You don't have to use your HSA money right away. You can pay for medical expenses out of pocket, keep your receipts, and let that HSA grow for decades. Then, when you're 65, you can withdraw money tax-free by submitting receipts from 30 years ago. Or if you don't have enough medical expenses, you can withdraw it for anything after 65 and just pay regular income tax on it, basically making it a traditional IRA with better rules. If you max out an HSA every year for 30 years, assuming 7% returns, you'll have about $422,000, tax-free. That's insane. Step 6. Max out your Roth IRA, $7,000 per year. Now we're getting to the stuff everyone wants to do first, but I made you wait because the order matters. A Roth IRA is your tax-free growth account. You contribute after-tax dollars, but everything grows tax-free forever, and you can withdraw it tax-free in retirement. For 2024, you can contribute up to $7,000 per year, $8,000 if you're 50 or older. And this should be one of your top priorities because of something called tax diversification. Here's what most people don't realize. It's not just about how much money you have in retirement, it's about how much of it you get to keep. If you have $1 million in a traditional 401k, you don't actually have $1 million. You have $1 million minus whatever the government takes when you withdraw it. But if you have $1 million in a Roth IRA, that's actually $1 million. Every penny is yours. Now you might be thinking, but Rihan, isn't it better to get the tax deduction now with a traditional IRA? It depends. If you're in your peak earning years, maybe. But for most people under 40, especially if you're early in your career, you're probably in a lower tax bracket now than you will be in retirement, which means it's better to pay taxes now at a lower rate and enjoy tax-free growth forever. Plus, there's another benefit nobody talks about. Roth IRAs have no required minimum distributions. Traditional 401ks force you to start taking money out at age 73, which means you're forced to pay taxes whether you need the money or not. Roth IRAs, you can leave that money alone forever and pass it to your kids tax-free. Step 7. Max out your 401k, $23,000 per year. If you've made it this far, congratulations, you're doing better than 95% of people. Now it's time to go back to your 401k and max it out. For 2024, that's $23,000 per year, $30,500 if you're 50 or older. Why did we wait until now? Because we already captured the company match earlier, and there were more efficient places to put our money in the meantime. But now that we've got those covered, the 401k becomes extremely powerful because of how much you can contribute. $23,000 per year is a lot of money. If you max this out every year from age 30 to 65, assuming 7% returns, you'll have about $2.4 million. And remember, you've also got your Roth IRA and HSA growing alongside this. This is where you start to see the real wealth building happen. Step 8. Taxable brokerage account. All right, if you're still with me and you're still putting away money after all these steps, you're officially in the top 5% of savers in America. Seriously, this is impressive. Now you open a taxable brokerage account and invest in low-cost index funds. Yes, you'll pay taxes on the gains, but here's the thing. You've already maxed out all your tax advantage space. This is the overflow. And there's actually a huge benefit to taxable accounts that nobody talks about: flexibility. All those retirement accounts, you generally can't touch them until you're 59 and a half with penalties. But a taxable account, that money is yours whenever you want it. Want to retire early, buy a house, start a business? Your taxable account gives you that option. Plus, long-term capital gains taxes for investments held over a year are only 0%, 15%, or 20%, depending on your income, often much lower than your income tax rate. Step 9. 529 plan for kids, if you have them. This is a side quest that happens in parallel with steps 6 through 8. If you have kids and want to help with their education, a 529 plan is the way to do it. But here's the critical thing. You do not fund college before you've secured your own retirement. Your kids can get loans for college. You cannot get loans for retirement. I see parents destroying their own financial futures because they feel guilty about not paying for college. Don't do this. Put on your own oxygen mask first. This sequence is designed to give you wins early and often. You get that $1,500 emergency fund pretty quickly, first win. You start seeing free money from your employer match immediately, second win. You kill your credit card debt and suddenly you have breathing room, massive win. These early victories build momentum. They prove to you that this works, and that momentum is what carries you through the harder parts. Compare this to someone who tries to max out their 401k from day one while they're drowning in credit card debt and have no emergency fund. They don't feel like they're making progress. They feel stressed, and eventually they stop doing it altogether. According to a 2022 study by Vanguard, 29% of people who start contributing to a 401k stop within 3 years. You know why? Because they tried to run before they learned to walk. They started investing before they had their foundation built. The order I gave you builds that foundation first. It removes the financial friction. It gives you stability. And then, only then, does it ask you to make big commitments. This order forces you to confront your actual financial situation. When you have to build an emergency fund before investing, you can't hide behind the illusion that you're doing something by putting $50 a month in a Roth while you're sitting on $15,000 of credit card debt. It makes you be honest with yourself, and that honesty is what leads to real change. All right, I know what some of you are thinking right now. Let me address the most common objections. But I want to invest while I'm young to take advantage of compound interest. I get it, and you're not wrong about compound interest being powerful. But here's the thing. If you're paying 22% on credit card debt, you're experiencing compound interest working against you. You're not getting ahead, you're treading water. The most expensive money is money you pay interest on. Get rid of that first. Then compound interest becomes your friend instead of your enemy. What if I can't afford to do all these steps? Look, most people can't max out every step immediately. That's fine. The point is to follow the order. Do step 1, then as much of step 2 as you can, then step 3, and so on. You don't have to complete each step fully before moving to the next, but you should prioritize them in this order. What about investing in real estate, crypto, or individual stocks? Those are fine after you've done steps 1 through 7. Speculative investments are not part of your foundation. They're the cherry on top, not the base of the sundae. I see so many people trying to get rich with crypto while they don't even have an emergency fund. That's not investing, that's gambling with money you can't afford to lose. This seems really slow. When do I actually start building wealth? This is the most important thing I'm going to say. Wealth building isn't slow if you're doing it right. What's slow is random investing where you're taking 3 steps forward and 2 steps back because you keep having emergencies that force you to pull money out or go into debt. Following this order might feel methodical, but it's actually the fastest path to wealth because you're not constantly sabotaging yourself. Money is simple, but it's not easy. The strategy I just gave you is straightforward. There's no tricks, no secrets, no complicated maneuvers. It's literally just do this, then do this, then do this. But the hard part is actually doing it consistently for years. The hard part is saying no to the things that feel good right now so you can build something that matters later. I started following this exact order when I was 25. I'm not going to lie to you and say it was exciting. It wasn't. Paying off debt isn't exciting. Building an emergency fund isn't exciting. But you know what is exciting? Being 35 and having more money in investments than most people have at 50. Being able to walk away from a job that's making you miserable because you have 6 months of expenses saved. Watching your net worth grow by $100,000 in a single year because you built the right foundation. That's exciting. The thing is, 5 years from now, you're going to be 5 years older no matter what. The only question is whether you'll be 5 years older with $200,000 in investments, or 5 years older still wondering why you never make any financial progress despite doing all the right things. You can start this today, like right now, after you finish watching this video. Go look at your bank account. How much do you have saved? If it's less than $2,000, that's your step 1. If you have that, are you capturing your full 401k match? If you are, what's your highest interest debt? Just start with step 1. That's it. Don't worry about step 7. Don't stress about step 9. Just do the next right thing. And if you found this helpful, subscribe to the channel because I'm going to keep breaking down exactly how money actually works. Not the fluffy advice everyone else gives you, but the real, specific, here's exactly what to do content that you can actually use. I'll see you in the next one.